All right, let's dive right in. Today, we're tackling a huge question, one that's really at the center of modern finance. For decades, the dream, the absolute peak for any company was to have an IPO. But now, in a world that is just flooded with private money, is that still the ultimate goal?
And this is the question that everyone, founders, investors, employees, they're all asking it. I mean, with what seems like a bottomless ocean of private capital out there, the old playbook for success, it's kind of been torn up. The game has just completely changed. So, companies today are basically standing at a fork in the road with two really different choices. Path number one, stay private. You get to keep control, you dodge all that intense public scrutiny, and you can still tap into these massive private funds. Path number two, go public. This is like the rocket launch. It gives you access to liquidity, a massive valuation, and that instant global credibility. And make no mistake, this isn't just some theoretical debate. This is a strategic decision with literally billion-dollar consequences. So let's break down how companies are actually navigating this new world and weighing their options. Okay, the first thing you have to understand is that the private market is no longer just a pit stop on the highway to an IPO. For a lot of companies, it's the final destination. With so much cash floating around from venture capital and private equity, a company can grow to an absolutely massive scale without ever having to list on a stock exchange. So what's the big appeal here? Why would a super successful company deliberately choose to stay out of the public spotlight? Well, the reasons are actually incredibly compelling. It really boils down to three huge advantages. First, you get the flexibility to focus on the long-term game. Second, you get to avoid that crushing weight of public scrutiny and regulation. And third, well, the money is just there for the taking. Let's dig into each of these. Now, this first point, it gets right to the heart of what drives so many public company CEOs crazy. They live and die by quarterly earnings reports. Every 90 days, they have to answer to Wall Street. And that kind of pressure, it can force you to think about this quarter's numbers instead of next decade's innovation. A private company, on the other hand, answers to a board that's usually thinking years, not months ahead. And then there's all the red tape. I mean, going public means a mountain of costly regulations. Things like SEC filings and Sarbanes-Oxley, which are super strict financial reporting rules. Not to mention, your every single move is put under a microscope by the media. Staying private lets you move faster and, frankly, more quietly. And of course, none of this would be possible without the fuel. We're talking about trillions of dollars ready to be deployed in the private markets. That means a really promising company can raise billions without ever needing to sell a single share to the public. So the case for staying private is strong. It's really strong. But despite all that, the dream of ringing that opening bell, it's still incredibly powerful. And that's because the public markets offer some unique advantages that are almost impossible to find anywhere else. The single biggest advantage is right here. Liquidity. It's a fancy word, but it just means you can easily sell your shares for cash. For founders, for early investors, and especially for employees holding stock options, the IPO is that magic moment when all their paper wealth becomes real wealth. This is a huge, huge incentive for getting and keeping the best talents on the planet. The next big piece of the puzzle is that a public stock is more than just an investment. It's a form of currency. A public company can literally use its own shares to go out and buy other companies. That's a massive strategic weapon for growth. Instead of burning through their cash, they can effectively print their own money to snap up competitors or new tech. And finally, there's the prestige factor. And you really shouldn't underestimate this. Being listed on the New York Stock Exchange or the NASDAQ, it's like getting an instant stamp of approval. It boosts your reputation with customers, with suppliers, with partners all over the world. It signals you've hit a certain level of maturity and stability. So, we've got these two very different paths, right? Each one has a powerful set of pros and cons. So how do we square all this? Let's bring it all together for the final verdict. And this chart just lays out the trade-offs perfectly. Take a look. You want high control? Stay private. But you'll have to answer to shareholders if you go public. You want to focus on the long term? Stay private. But you'll be chasing short-term earnings if you go public. Minimal regulation versus extensive and costly rules. Each path demands a sacrifice. The whole game is about deciding which trade-offs your company is willing to make. This brings us all the way back to our main question. If private money can fund a company to almost any size, what is it that the public markets have that's truly unique? What's their irreplaceable secret sauce? And here's the bottom line. It really comes down to these three things.
While the private market lets a company grow to a massive scale, the public market remains the undisputed champion for these three pillars: unparalleled liquidity, a powerful currency for acquisitions, and instant global credibility. For now, at least, you just can't get those anywhere else.
And that leaves us with one final fascinating question to think about for the future. As these private markets get even bigger and more sophisticated, will they invent new ways to replicate those three key advantages? Are we going to see a future where going public isn't the ultimate prize anymore, but just one of many options? Now that's the billion-dollar question that's going to define the next chapter of finance.